Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Hope you're all doing very well. Back on the island, spending some time here in Australia. Today, I have a stock analysis for a company that's been added to my private portfolio and to the eToro portfolio, which you can view publicly. The goal of today is to give a broad-based overview, so short video to the point with the investment thesis. And if you're interested in really taking a deep dive into the subject matter that I'm mentioning today, there'll be a link to the Substack in the description. You can go in there, you can get free access to most of it, you can get a free trial, and you can really take it for a spin for those of you who really want to get into the nitty-gritties. That way it won't take up too much of your time in the video. Disclaimer, nothing I say here is advice, guys. It's just me giving my thoughts and my take out there, sharing it with you guys for more of the investment research and that sort of thing. As I said, you can take a deep dive that's available in the Substack. Thank you to the subscribers. If you're not subscribed to the YouTube channel, please do so. Just like and subscribe. It really does help, and it doesn't cost you anything to do so. So I would appreciate that. Those of you who haven't already seen the portfolio, it is available on eToro. You can just simply take a look, you can copy it, you can do whatever you want, and reminder to subscribe to the YouTube channel. So here we go. Meso macro, working our way down. I'm looking at a stagflationary environment, which I've been calling for the last few years, that it really seems to be heading more and more that way. How do I protect myself and grow my capital in such an environment? And I think that that's only starting to dawn on several asset managers out there in the capital markets. So land, why is land so interesting? Most of the time, it's not interesting at all. It's very, very boring, and it's a long-term, slow cooker type of play. There's a really great article from Horizon Kinetics talking about land as the ultimate perpetuity, and I reread it recently, and it's really got me thinking. Land can provide perpetual cash flows over multiple different uses. Of course, you can have cash flows from rents, from developed real estate, or you can obviously lease out raw land, agricultural or resource production. And you can have access to all of the above, including mineral royalties, depending on where that land is situated. And that's what we're going to talk about today, a company that has access to all of the above. It's a perfect storm, perfect business for the environment in which we're in that it has beneficiaries from commodities, which will benefit from inflation. It has flexibility in how the land can be used, multiple different revenue streams, one of which, over 28% of its revenues, come from oil and gas and mineral royalties. You've got limited supply, obviously, in terms of land, tangible asset, inflation hedge, and optionality, which I've mentioned. This company in particular is of interest to me because it's unencumbered. It doesn't have any large outstanding debts to service, strategic land in a strategic area, and they are, as mentioned in the Kinetics commentary of Q1 2023, if you guys are interested, they are indeed the ultimate inflation beneficiaries. So the company's Tejon Ranch company. The price has recently gone up above $16 when I was looking at this. It's 17 and change as I woke up this morning. Enterprise value $434 million, and that's going to be important. Shares outstanding, not many, 26.8. And I really want to talk about the book value, or the book value of the company as it's stated on the balance sheet, but what I think it really can be worth if one were to put things in perspective and value things as they are today, not necessarily as they've been included on the balance sheet. And you guys are going to see exactly what I mean, hopefully. So the investment thesis, if I put this on one slide, and in the monthly Substacks that do deep dives, I try and put into one sentence. The idea here is that Tejon Ranch currently holds a significant amount of land that I think has a hidden value on the balance sheet. It's not being accounted for. It has 270,000 acres of land holdings in Southern California. Now, obviously, they won't be able to use all of that necessarily to unlock the value, but it's a massive, massive sprawling area, roughly, I believe, the size of Los Angeles. So it is significant. It enjoys a superior inflation resistance business model, and that's going to be important. They're growing royalties and agricultural cash flows can fund the operations that'll be needed, the capex needed to unlock the asset value of that land. Okay, so instead of having to take on a huge amount of financing, which they'd have to service and it would increase the risk, they already have revenue producing activities on that land. In a way, it reminds me of Texas specific land holdings. They started off as a land co, then they were an oil royalty co, and now basically they're almost like Tejon in that they have about a third of their revenues produced from water-based royalties. So you can get an idea of the optionality that these types of businesses have. Long-standing businesses, both these Texas and Tejon have been around since 1800s. Okay, so it gives you an idea as to the sustainability and adaptability of these businesses. It's got no debt really to speak of, and it has a proven value accretion chain in terms of its land. It's not without challenges. We're going to talk about that. But the concept has indeed been proven. 5-year chart, the only interesting thing about this is that the price has just chopped sideways over 5 years, whilst down the bottom here, you can see the book value has been steadily accreting up and to the right. That's the only thing I wanted to show. If we take a look with our friends from Koifin here, we've got the price, we've got the enterprise value, which is more important than the price, and you have the book value. They would be the first three columns. So what's interesting about that? Well, the enterprise value is about as cheap as it's been in the last 20 years, which is pretty crazy. The book value is the best it's been in the last 20 years, growing up and to the right. And yet you've got the price to tangible book at the lowest it's been roughly in 20 years. Okay, so what does that mean? It means they're growing the value of the asset, and yet the price or the multiple which we're being asked to pay for that growing asset is going in the opposite direction, which is very strange. Mostly, if I were to take a guess as to the reasons why, it's because the pricing and the multiples that investors are willing to pay fluctuates around the sentiment of how confident people are that they can realize their development projects. Okay. Talk about that in the deep dive in the Substack. So here's what they have been able to do in their first successful development venture, let's call it. Tejon Ranch Commerce Center is a small part of their overall land holdings. And what they've done is they've taken the raw land and they've got permits for developing an industrial center where they lease out to the likes of IKEA and whatever else. They have big service stations or gas stations. And then, of course, on the commercial side of things, you've got retail space where restaurants and office merchants and whoever else take a commercial lease. In addition to which, they also build adjacent community living, let's call it. Multifamily, I believe, in the US is the term. So they've got residential housing in line with these commercial industrial centers, essentially creating mini city centers. That's what they're planning to do. They have many different developments planned. The Tejon Ranch is the first one that's really coming to fruition. The others are involved in litigation with the eco-Taliban and all that sort of stuff. We'll talk about that later. From here, the point is what they're doing is they're taking raw land, which has a value currently valued at around 1,500 or 1,600 if you use today's market cap. And they're saying, well, as raw land, it's worth this. If we do developments, it's worth whatever it's worth. So industrial land, they've been able to improve the value to this amount per acre, so 382,000 per acre. And then the commercial land can be extremely valuable from 261 to over $1 million an acre, depending on who the tenant is and where it's situated, obviously. So this is the value accretion chain I mentioned that they're trying to do. Obviously, it's going to depend on the location of their developments. But the point is, currently the whole company is being valued at their land holdings of this, roughly 1,600 as of today. And do I think that's appropriate? And I don't. I think that they can get quite a significant more, a greater value per their acreage. Here's an example. So in the Commerce Center, their model is they contribute the land, they take on a partner, Their partner develops whatever they're developing. So in the case of the Petro shopping center, they'll develop their gas stations and shopping centers, and then Tejon Ranch will be left with 50 to 40% of the profits from there on in. So this is where you can see it's a perpetuity business. The beautiful thing about that is really Tejon doesn't take on an awful lot of risk, really. They contribute the land they already own, unencumbered, remember, and the development partner, or they themselves, in some cases, do the development, and then they split the profits from there on in. Okay, it's a beautiful, beautiful long-term business model for those with patience. The land. So here's an indication as to what that asset value could be worth overall if you take a step back and think about things. So currently, this is what they have in terms of purely farming. Okay, purely farming, which is the second step up from raw land, as if it's been converted to cropland. So it's a little bit higher on the value chain. 4,100 acres already in situ, 1,200 for potential development already. And in the local area, you'll find the going rates or the values of that farming land is 15,000 to 25,000 an acre, obviously depending on the crop. So at an extremely rough back of the envelope calculation, I'm not for a second suggesting that the entire 270,000 acres can be as valuable as commercial land because they won't be able to develop all of it. And they won't even be able to put farm crops on all of it either. But could they go overall for their entire company? Could they get it to at least 10,000 an acre in terms of its valuation, which again would not be crazy in my opinion, given that it's the cropland they're currently trading for this in terms of their value. So I think that as a rough start, if you were to take all their land and if as a whole company, as a whole ranch, they could have it average across the board at 10,000 an acre, that would suggest $2.7 billion worth of land value or about $100 a share. And if that took 10 years to eventuate, and remember, land will keep pace with the inflation presumably over that time, that would still be a 20% IRR. So if you were extremely patient, you could afford to be patient and receive a handsome return. Obviously, there's a lot more work needed than that. It's you can't just look at that and extrapolate, but it's just a starting point for me to see, is it worth me going deeper? And I think that the answer is yes, it is worth. So let's ignore that for a second and just look at what they already have permitted in construction, due to be completed in the first half is in 2025, and then presumably the whole commerce center will be completed by 2026. They already have a large amount of their industrial and commercial space occupied, and they're enjoying the revenues from that. So let's just use that for starters and see where we get. So what do they got? They've got 11 million square feet of commercial space. A lot of that is already taken up. Commercial rental, 956,000 square feet, and then the residential development, including what we already know about their farmland. So this is what we have a good idea. How do we value that? Everyone is going to come up with a different figure. As my uncle Rick would say, you don't have to be perfectly right. You just need to be more right than the next person. So here are my assumptions to have a stab at the value of just this aspect of their development. Okay, just this one project. We've got an average annual triple net for the area, according to what I can find at least, $12 a square foot, 18 for the commercial, and Bakersfield has been used as a comparable for the residential rents, okay, which is I think a town or a county in the area. Use 10% vacancy, 20% OPEX, and a 5% cap rate. Sounds aggressive, but it's in line with their historical valuations from what I can make out. You plug in the numbers. I won't go through them. I'll just save you time and come up with some of the parts for this one project. And you're looking at roughly 3.15 billion for the total. Okay. If you were to use a 7% cap rate, which would be above the average annual estimates for the last 20 years, you're looking at 1.7 billion. Okay, on a per share basis, we're still looking, we think worst case is a triple if you take 50% for the joint ventures across the board. A lot of these, so the residential is sole development, they're not taking on a partner. But to give us an idea, a rough idea, somewhere between 64 bucks and 118 a share. Then you also have the rest of the ranch, so roughly 263,000 acres as a call option. You're getting it for free, it's not priced in. And so whatever happens, happens. This is interesting to me. Okay. I don't know what's going to happen to the rest of the ranch. My suspicion is that eventually these projects will be built. I go into detail in the Substack. So what's left? We've got, let's just call it a billion for the complex, which is more than twice the current market cap. They also have four other main projects at various stages of the approving, permitting, and development pipeline. Mountain Village, Centennial, Grapevine, Grapevine North. Now, Grapevine was, no, Centennial was really quite close. It had permits, and then LA County judge rescinded the permits because of environmental reasons for revisions and all this sort of stuff. So you got this back and forth. It'll take ages to develop, but eventually I believe it will. And if you're not being asked to pay for that today, whatever, you can afford to be patient, in my opinion. Overall, here's what space is on offer. Here's what the company wants to eventually develop in terms of their residential properties. And using similar estimations to what I did before, I've just put this on paper to see what it could be worth. So if you ignore what's already in production or in construction, and you say eventually there's a total future development value somewhere around the 12 to 13 billion dollar mark. And even if they were to realize half of that valuation at $6 billion, that is more than a 10 bagger from here today. Okay. If they can do better than that over time, then obviously you might even have who knows what. It's honestly, it's anyone's guess. So I think the way to think about it is what they're, it's not, the company's not losing money in their operations so far. Um, they have good, steady business. It's not making money, but it's not losing money. It's able to use those funds into development projects to unlock their asset base over time, which is really their land. Who owns this? Who's the management? Who's in charge? So you got Tower View, which is a looks like a holding company for this fellow here, Daniel Tisch. Tisch family made a lot of money, I believe, in hardware, and now own a lot of the land. So he's invested heavily through the company and through his personal capacity. Greg Bailey's a director. So you've got these guys here that have sort of 18 million and 7 million personally invested in the company, in addition to which you've got the investment company Tower View, which, as I mentioned, is really Daniel Tisch, or at least the Tisch family. So the verdict, again, that's even longer than I wanted to go into the video. I'm long the stock. It's a very deep value play. It will require patience, I fully expect, but it has a large margin of safety. It's got unencumbered land. Its OPEX and development costs, so OPEX and CAPEX, is currently covered by the cash flows. It's an inflation-resistant business model, and it's a likely 10x, in my opinion, at some point. Whether it takes 10 years, whether it takes 100 years, I can't answer that. But I think that there's an enormous amount of value, an enormous margin of safety. It's at the most developed that the company has ever been, precisely as I showed you, at the time where the company is, the multiple for the book value is the lowest that it's ever been. So with the first part of the Commerce Center being due for completion next year, and then presumably 100% complete in terms of the residential dwellings in 2026, that will, I think, really be a catalyst to unlock a lot of the value, because people are going to look at it and say, hey, they have successfully developed one project on their books. It's a matter of time before they can get through some of the other rigmarole and develop even bigger projects which are in the pipeline. So it's in the eToro portfolio. I'm looking to build on that. It's in my personal portfolio, personal wealth portfolio as well. And all I can say is that this one will require a lot of patience, most likely. And all you got to do is, what I'm doing at least, it's not advice, what I'm doing is just setting up a position and forgetting about it until that development milestone is achieved and the value is unlocked. Presumably, investors start to see it. Thank you very much for watching. Wishing you all the very best. Please do like and subscribe. And if you're interested in further analysis like this and more in depth on Tejon Ranch Co., you can access that via the Substack. The link is in the description. Take care, guys. Do your own due diligence, and I look forward to seeing you in another episode shortly. Take care.